Join me on this podcast as we take a virtual trip to Jason and Kim's office to find out how taxes affect investments. Tune in and discover how you can benefit from intelligently managing your portfolio with these small yet effective tax tips. See you soon.
Man, I did my taxes over the weekend. I really got hammered because of the profits I made on my investments.
Wow, I never really gave much thought to taxes other than a paycheck.
My accountant gave me a crash course. You're taxed on capital gains. This is from selling an asset for more than its purchase price. The effects of these gains differ based on different scenarios and investment types.
What do you mean by different scenarios and investment types?
Short-term capital gains are profits from selling assets held for a year or less. These gains are subject to a higher tax rate. On the other hand, long-term capital gains come from assets held for more than a year and are usually taxed at a lower rate.
That's good to know. So, you have to stay mindful of the asset's original value?
You sure do. That's called the cost basis. This taxable income is not only impacted by the duration held but also influenced by the investment type.
How do I determine the cost basis?
Some brokers automatically apply the first in, first out, or FIFO method to calculate the cost basis. For example, an investor buys 400 shares of a stock but over the course of 4 different days. On the 5th trading day, the investor decides to sell 100 shares. The FIFO method prioritizes selling the oldest position first.
That doesn't leave the investor with many options.
Well, that's where the specific identification method comes in handy. This method gives the investor more control over their tax liability by allowing them discretion what lot to apply the sold shares to.
Explain how dividend and interest fit into all this. Are they taxed also?
Yup, they are taxed also. Dividends are taxed at either an ordinary or a qualified rate, where the qualified rate is lower. When it comes to interest income, it is usually subject to ordinary income tax rates, but may qualify for certain federal exemptions.
I see. Can losses offer any tax breaks?
Absolutely. You can offset losses with gains to reduce your taxable income. If you have a losing position that's still open, you can take advantage of tax loss harvesting for a tax break.
I'm not familiar with tax loss harvesting.
It's a popular tax strategy used to minimize tax obligations and maximize returns. Simply put, it's selling losing investments to offset the gains from other investments. If an investor has a capital gain of $10,000, and they have an investment they feel is underperforming, they would sell that asset to reduce the taxable income. Through the process of that sell, they could reinvest that money into something else. Another cool strategy is deferring losses. Currently, if you have more gains than losses, the IRS allows you to carry over leftover losses into future years for saving later. Talk to your tax consultant, I'm sure they know all about it.
Are you kidding? So I can dump a losing stock and buy it back at the lower price? That's genius.
Slow down, Einstein. That would be a violation of the wash sale rule. The wash sale rule prohibits a tax benefit on such transactions. Once sold, there is no tax benefit for 30 days before or after the sale.
Oh well. So tell me, how do different investments affect your taxability?
Currently, investments like futures, options, and Forex typically use the 60-40th rule. 60% of the gains are taxed at the long-term capital gains rate of 15%, and the remaining 40% is taxed as ordinary income.
That's a lot to take in. Guess that's why it is important to manage your portfolio carefully.
It sure is. I wish I would have reached out to my accountant earlier. I'm telling you, he's full of great tips and advice.
Well, maybe you can give him a call tonight for some fashion tips.
I hope today's podcast was helpful. Should you engage in the financial markets, be sure to look out for a Form 1099 from your broker. You'll need it when you file your annual taxes, and always consult with the professionals. Well, alright, that's all for now. Catch you later.